All right, looks like we are live on all platforms, and we're excited about today. We've got a special guest, Dustin Snyder, who's a valuation expert. He works with a company called AltaView Advisors out here in Salt Lake City. He was actually one of our guest speakers at one of our panel discussions at the previous acquisition conference. But before we get into that, I wanted to share a little bit more about the acquisition headquarters. We had previously been under the title of Acquisition IQ. We've now made a rebrand to make it a little bit larger. We are now the head of or the acquisition hub, and we're excited about as we start to expand that vision. So the goal for today is simply to establish purpose and value for one, the acquisition headquarters, and then two, help you as the viewer to learn more about how valuation is important for you to know with the development of the value within your business, so then you can ultimately exit for maximal value. Moving on, who are we? We're Acquisition Headquarters. It's a premier community for business owners, investors, and service providers to grow through mergers and acquisitions, as well as individuals who we serve are the seasoned entrepreneurs and operators, anywhere between 2 to 50 million in EBITDA. We also serve individuals who have holdcos and that are looking to strategically acquire companies, as well as the M&A service providers that can provide the much needed mentorship throughout the process of an acquisition. Some of the problems that we've noticed is the lack of education to increase the overall understanding of a transaction, both pre, post, and during an acquisition. And then, in essence, the lack of resources that are available, as well as the relationships that are a little siloed in this specific industry. Our goal is to continue to build trust and build teams. And at the end of the day, we're increasing efficiencies around that specific topic. Our current traction as an organization, we truly are excited about the successful launch of our September 3rd, 2025 conference, which is now setting up massive momentum into our March 5th and 6th conference. With our total private membership is 80 plus, and now we have just completed our fall tour, which we're glad to be over, and we're moving on to our next year. We also have, as a part of our collective for the acquisition tour, or sorry, the acquisition brand, we have the Alaska Northern Lights incentive trip, which we have. Moving on, these are just a few pictures, just to give you a little bit of an understanding of what our events look like and some of the areas that we do serve: Colorado, San Diego, and we also have Salt Lake City. These are just some of the pictures that we just experienced a few days ago at a wonderful art gallery, meeting and greeting and just sharing each other's knowledge, time, and experience at a wonderful venue there in Park City. More and more of these events will be hosted and also benefited on November. So we love that we're going through that. So where are we heading? The national conference is going to be on March 5th and 6th, and then our AIQ or AHQ now councils are going to be launched on the beginning of the year. So we are stoked about having you guys, and we are going to be starting with Dustin Snyder. Hey, Dustin, are you there?
Yeah, I'm here.
Awesome. So Dustin, again, he's been working with companies to help them understand their understanding their valuations, and just making sure that, in essence, you understand the drivers that can increase the value of your company. So without further ado, I'd just like to welcome Dustin here to, in essence, the digital stage, and then allow for him to share a little bit about what he's prepared for today. Dustin, thanks a lot for joining us.
Hey, my pleasure, Nathan. Thanks for the invitation. Uh, like Nathan said, I'm a valuation specialist. I've been doing this since about 2009, so I've got about 15, 16 years of doing this as a profession, and I do want to make one thing clear. I'm not a broker. I don't help people sell their businesses. It's, there's brokers and investment bankers that do that. And a lot of the principles that we use to value businesses are the same, but usually when I'm getting involved, it's typically when someone needs a valuation that has to go or be attached to like a tax return, or they're doing estate planning, they're gifting ownership interests in their businesses to the next generation. That's kind of the work that I specialize in. But these concepts are really valuation concepts are really valuable, um, as a business owner. If you understand them, you can essentially you can track the value of your business over time, or a rough valuation of your business, and then you can understand the what you can understand, if you implement new strategies, uh, make cost cutting efficiencies, you can kind of understand the value that those decisions are driving within your business, which is really powerful. Uh, I've kind of already gone over my background here. I guess uh, one more thing I'll note is that I recently joined AltaView back earlier this year, which is kind of a boutique valuation firm where we specialize in tax and compliance valuation work. Prior to that, I was with a large national valuation firm excuse me, public accounting firm where I specialized in valuation there, called Moss Adams, which was recently acquired by Baker Tilly. So I guess I've prepared some talking points today, but I'm happy to take this any direction. If anybody has questions, we can dive into stuff further. But the objectives that I've prepared are kind of to give the audience an understanding, a basic understanding of how businesses are valued, and then we'll talk about things like company-specific risk factors and how mitigating those risks can increase the value of your business. And then we'll dive into some case studies and highlight some actual examples from engagements that I have worked on, or colleagues of mine have worked on. So I'm going to pause there to see if anybody has any initial questions before I keep moving. Okay. So basic valuation techniques. There's three general approaches uh, in when it comes to valuing a business. There's the income approach, the market approach, and the asset approach. And within the income approach, there are two general methods: the capitalized cash flow method, and then the discounted cash flow method. And the the difference between those two methods is, uh, with the capitalized cash flow method, you're basically taking what you deem a normalized cash flow stream, and you're assuming that's going to continue off into the future, uh, and you're going to capitalize it. It's a really great method for companies that are really mature. They have stable, low and stable growth, and they have stable margins. The discounted cash flow methodology, however, is a great method when you have companies that are growing and they haven't reached a stable rate of growth or stable margins. So you can actually forecast a company's cash flows out into the future, using different growth rates, using different margins, and even different discount rates, which I'll get into more later, which is essentially how you measure one of the ways you measure risk using the discounted cash flow method. And then within the market approach, I'm sure most people are familiar with, uh, applying a multiple to like a revenue stream or an earnings stream like EBITDA. That's the gist of the market approach. And where those multiples come from, the source can be similar guideline public companies. They can be private companies that have traded or been bought or sold in the past. If you can find that information, you can leverage You can leverage it to come up with some implied multiples. And then also you can use actual transactions that have occurred in the company's recent past. And then last but not least, there's this asset methodology where essentially you just take a balance sheet and you adjust all the balance sheet items to market value. So this approach typically is used for companies that are very asset intensive. Uh, a good example would be a heavy construction company where they own a lot of equipment. Sometimes in cases like that, it's also those are typically low margin industries. So sometimes the value of the assets can actually be worth more than the value that would be derived from like an income or a market approach. So that's kind of a high level overview of the basic methods. Um, let's see, we've already kind of covered all this. So let's jump into kind of an example. So let's assume we've got a regional medical staffing company that's serving Utah. As you can see here from their sales, they've had some nice growth over the past few years, growing from 20 million to 40 million. They're expecting to grow from 40 million to about 50 million over the next 5 years. EBITDA margins have improved over the past from about 2% to just shy of 6%. And you can see from an absolute dollar standpoint, EBITDA is growing in line with sales. And that margin expansion is expected to continue somewhat, but it's kind of slowing down. But dollar-wise, EBITDAs continue to grow. So I highlighted some of the strengths already. It's got some pretty good growth. It's got expanding margins. There's some good industry tailwinds that are helping drive growth for this company, like an aging population, baby boomers needing more healthcare. And then there's also some expansion and opportunities, new services that could be added, new markets that the company can enter into. However, on the risk side of this business, there's some key person risk. Typically when we see key person risk, it's one person is wearing a lot of hats, or one person is holding a lot of relationships, and there's not a very deep bench. So if that person were to be hit by the proverbial bus, the company would be in trouble. It's got some customer concentration. It's got some industry concentration, a little bit of projection risk, and it is small in size relative to its publicly traded peers. So now, with that background in mind, here's what an income approach for this business would look like at a high level. I'm not going to try to dive too deeply into this, but uh, as you can see, we've mapped out the sales over the next 5 years, EBITDA over the next 5 years, and the way that we get to free cash flow, which is the important metric in the discounted cash flow method, is we uh, add back depreciation. That's a non-cash expense. We deduct our capital expenditures, and we deduct or add changes in working capital, and then that gets you an unlevered, and it's an unlevered free cash flow because it does not include interest expense. So essentially, these are dollars that are available to uh, debt and equity holders. Okay. And then those cash flows out into the future, to understand what those are worth today, they get discounted by a discount rate. In this case, we're assuming 15%, and you apply that discount rate to those future cash flows, and you end up with the present value at 6.7 million. And then there's this terminal value, which is essentially what the business is worth at the end of, in this case, at the end of 2025, and then it's discounted back to what the present value would be today. So overall, we wind up with an enterprise value of 17.8 million. And Enterprise value, typical definition for that is the market value of all capital, so debt plus equity, but excluding cash. I'll pause there. Any questions? Anything I need to discuss further, or should I keep rolling?
Dustin, I have a question. Can you walk us through how you derive at the discount rate?
Yes, yes. Let's do that right now. Great lead into the next slide. So there's a couple of different ways to come up with a discount rate. Uh, I would say the two, the one that most people are familiar with is the capital asset pricing model, or CAPM. And so that's what I'm going to focus on in this example today. But there are other methods. One that's really popular and that we use a lot in practice, especially appraisers, is called the build-up method. And that's one that's very popular in tax court. It's easy to explain and when you're on the bench. So, but I think for our purposes today, we'll focus on the capital asset pricing model. So essentially you start with a risk-free rate, which is typically like a 10 or 20-year treasury rate. So if you're not investing in the market, in securities, the best place or the safest place to put your money would be in government treasuries. That's technically a risk-free environment. And that's this at this time, this is pretty low. It's a few years ago. Now this is closer to like 3.6%, 3.5 to 4%. But you take the risk-free rate, and then there's this premium that you add to the risk-free rate that is called the equity risk premium. And now this basically gets us to a level of risk of where we're investing in a diversified portfolio of equities. Okay. So you go from this 2% and you add in an equity risk premium of 6.2. And then there's other premiums like industry. Certain industries have more risk, some have less risk. So there's industry premiums that we add on there. And then as you can see here, there's a size premium as well that we can add, which ultimately gets us to a cost of equity. And one thing I skipped over here, this company specific risk premium, this is probably the most this is the most subjective input in the entire capital asset pricing model. And this is really where professional judgment comes in, or just knowing your business. Because again, these inputs that I'm talking about, they're coming from the public markets. They're being derived from publicly traded companies that are often much larger, more diversified, have better management, have better access to capital. So we need to make some adjustments to make make it more comparable to a small privately held business. So in this case, we've tacked on some key person risk, some customer concentration risk, some industry concentration risk, and some projection risk. So again, that derives a cost of equity of 16.5%. And then you take the capital structure of the business. And in this case, we're assuming that the company is funded 10% by debt and 90% by equity. And you do some simple math there to end up with a weighted cost of capital of 15%. And the way you get that is you take the 90% equity times the cost of equity, the 10% of debt times their cost of debt, and you get the 15%. So that's a Patrick, that's a pretty high level of how we come up with this. But again, at the end of the day, we're trying to get a number that reflects the riskiness of those cash flows that we showed on this previous slide.
Can I ask one other quick question? Because I get asked this sometimes. I want to make
Yeah,
sure I'm telling people correctly. The CAPM, so the CAPM model where you derive to a discount rate, is discount rate and WACC, the weighted average cost of capital, are those used interchangeably?
they are.
Thank you.
They
I've
are.
thought
And
so, and I've told people that, but I wanted to make sure that that is the case.
yeah, they also get called like if you're doing capital budgeting, where you're so another use case for this model is to do capital budgeting. And you can, if you're a business and you want to understand the value of a certain initiative that you're trying to roll out, um, you know, we learn this in finance. You do a net present value exercise, and if you compare your implied internal rate of return to your cost of capital or your WACC, and you can decide if it's worth taking on that project or not. I don't know if any of you remember taking that in finance, but it's kind of the same. It's the same process.
So would it be valid to say that, there again, those terms are used interchangeably, but would it be more realistic to say, okay, discount rate is used for valuations, but WACC is more used for actual budgeting purposes?
They're 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 used interchangeably. Our valuation reports use the WACC terminology more than the discount rate terminology, to be honest. And then one other important thing to note is that discount rates are inversely correlated to value. So the higher the discount rate, the lower the value. Uh, a 15% discount rate, that's pretty common for a business that's doing well, 10 plus million in revenue, has good consistent earnings. For companies like startups or venture-backed companies that aren't cash flow positive yet, you can get into discount rates up into the 40, 50, 60% territory. So this is just the moving on to the market approach example. Uh, you in this case, we're able to find several good medical staffing companies or staffing companies like Robert Half, similar business model that uh, are reasonably comparable to this business, and then you end up deriving their we're showing sales enterprise to sales valuation multiples and enterprise value to EBITDA multiples here. We've got 5-year averages, 3-year averages, latest 12 months and next fiscal year. And once you've found publicly traded companies that you feel are reasonable and you've calculated all the multiples, the difficult part here is, we've got a range of, using this EBITDA LTM multiple, for example, we've got a range of multiples from 5.6 all the way up to 17.1 times. That's not exactly tight. So where does my company fit in that spectrum of of value? And one of the ways that what you can do to kind of hone in on what you think is the correct multiple is you can do um, comparisons based on size, growth, and profitability. And I don't know if you can see this. This is kind of small, but our example company here, it is by far, well, not by far, there's actually some pretty small publicly traded companies in here, but there's also some juggernauts. But we are on the small side down here on the bottom. In terms of growth, however, we're we're in the upper quartile. And in terms of profitability, we're kind of middle of the road. So you could start with the median from the guideline public companies of 10 times, say, hey, we're a little bit better in terms of growth. We're going to adjust that up to 11x, but then we're a lot smaller. So let's take a haircut of 1x. And then we've got some other company specific risks that these publicly traded companies don't. So let's take another haircut of half a turn. And we get to a number of 8 times. And uh, you know, this is where the art comes into valuation. Uh, you could get a bunch of appraisers in a room for this same company, and they're all going to come up with a different multiple. They're all going to come up with a different discount rate. What matters at the end of the day is that you can support what you've selected and you've got a good story to back up what you're doing. So the narrative is very important here. Now on this slide, we're talking about what happens if we're able, we said this company has some company specific risk due to key person risk and industry concentration and customer constant concentration. So under the base scenario, we had a $17.8 million enterprise value. The implied EBITDA multiple was 8.2 times. What happens if we're able to de-risk our subject company from a 3% company specific risk premium to a 2%? Well, that adds that increases the enterprise value to 19.5 million. It increases the implied multiple to 8.9 times. Uh, let's say we're able to grow our company in terms of size, whether that's sales, total assets. That also results in a lower size premium. That has the impact of increasing the value as well. If you're able to, de-risk, increase your size, increase your growth, uh, at the end of the day, you're able to take an 8.2 times implied EBITDA multiple and increase it to 10 times. So what we're just trying to demonstrate here is the power of focusing on your business, asking yourself, where is the risk? What is a potential buyer going to see as a risk of my company? And what can I do to mitigate that risk? And it's definitely worth your time and effort to do that, because in this case, if they're able to do all these things and de-risk, it's almost two turns of EBITDA in terms of additional value. Okay, I'm going to pause there again. Any questions? All right, let's get into some actual examples. I'm going to skip ahead a little bit here. How are we doing on time, Nathan?
Yeah, we're doing good. I'd just like to, yeah, let's go through some case studies as if, we are business owners here sitting in the seat, and
Yep.
also making sure that we can create actionable items for those that are also listening. And then I think you were just sharing some history of how do you come to the numbers, which I think is really good for us to understand, the value drivers and the metrics behind it. But yeah, doing great. It's very good information. Thank you for sharing.
Yeah. So case studies. This first one, it's an e-commerce business. We were doing a valuation for this company for estate planning purposes, leading up to a potential sale or a initial public offering. So essentially, the uh, the business owner wanted to get these assets out of his estate before there was a huge wealth creation event. So we were brought in to value this company. It did about 100, had about 170 million in revenue, 16 million in EBITDA, and there was significant distribution channel concentration with a major e-commerce platform. And because of that concentration, the M&A deal never closed because of that one particular risk. So just one example of how risk with a certain one, having one key supplier in your business can make, or in this case, break a deal from happening. In this next example, uh, have an industrial integration business, and they were doing about 50 million in revenue, 80 million in unadjusted EBITDA. Uh, that revenue number can't be right. That must be a typo. Must have been 150 million. But let's go off these EBITDA numbers. 80 million in EBITDA, 107 million in adjusted EBITDA. There were significant uh, significant add backs in this case. So anytime you start seeing companies making significant add backs, So there's a huge difference between their reported EBITDA and then their adjusted EBITDA, or in some cases, the the deal EBITDA. Buyers start to get a little worried, wondering, hey, what the heck is going on? Why are there so many ad backs? Why are these ad backs so big? So in this case, business was valued at 7.6 times EBITDA, despite investment bankers trying to pitch it at 10 to 14 times EBITDA. And then there was a sale attempted in 2018, and it was ultimately terminated due to quality of earnings issues and some exposure to the aerospace industry that just presented too much risk for potential buyers. So I know Patrick does Q of E work. I don't know, Patrick, if you've ever been in this boat where a deal is blown up because of a bad Q of E, but I'm sure it happens.
Never, Dustin. Never. Yes, a
So,
couple.
so, so the
What's
moral of
up?
the story there is, have some good financial discipline, some good accounting discipline at your company. Don't wait until right before a sale just to start trying to clean up your books. I think it's a good goal to have a couple of years of audited or reviewed financial statements going into a potential sale. I don't think I've ever seen a Q of E with less than 2 years of historical financials in it. So that I would say that's a good pro tip.
Yeah, excuse me, Dustin, can I ask you a question about your comments around the unadjusted EBITDA,
Yeah.
right, versus adjusted? So, maybe in this example or others, you've felt like, so where is it? It seems like unadjusted is kind of a gray spot as to what the seller puts in that bucket versus not, right? And this one you said there was, the buyer had some obvious concerns with the unadjusted. Right? So, can you talk a little bit further about that?
Well, I think the concerns were with the adjusted EBITDA.
Adjusted, okay, sorry.
Yeah, in this case. So we had an unadjusted EBITDA number of uh,
Maybe.
we have an unadjusted EBITDA number, and then there's all these add backs that are happening.
Yeah.
Um, you know, whatever they may be, add backs can be sometimes owner normalizing owner comp, or hey, we've got
Hmm.
we've got somebody on our management team that we actually don't doesn't really do anything. You see this a lot in privately held companies where they've got a bunch of kids and they're all on the payroll, but some of them
Right.
aren't doing anything. So I think it made the buyers nervous in this case just to see such a large deviation difference between reported, or in other words, unadjusted EBITDA, and
Hmm.
then what they were trying to argue was, hey, here's what our EBITDA should really look like were it not for all of these kind of uh, discretionary items that we're running through our business.
Right. So that led to the other bullet point. They're valued at 7.6 versus the seller was at 10 to 14, right?
Yep,
That's the correlation.
yep,
So so it didn't go through because of this particular issue or one of the two issues, right?
correct.
Okay. All right. And so in your experience, have you, if you were but in this case, how would you come at like you argument that it's that the kids aren't really anything? We value it at 7.6, right? Because there's a lot of intangibles there that won't come with the sale.
Sorry, Mark, you kind of broke up there. Can you repeat the question?
Oh yeah. So in your experience, if you were the buyer in this particular case study, right, you're going to say, look, you have all these kids on the payroll not doing anything. We value it at basically almost half, right,
Yep.
what the investment is. Um, so obviously it didn't work out here, but in your experience, is that just a matter of a horse trading back and forth between the buyer and the seller and agreeing what is considered unadjusted versus adjusted?
Yeah. Yeah, exactly. I mean, you've got you've got you've got investment bankers trying to inflate value as much as
Yeah.
possible. They're incentivized to do so, and then you've got buyers who don't want to overpay. So, yeah, at the end of the day, they end up meeting somewhere where everybody's comfortable.
Yeah, no, that's what I thought. I didn't know if you had like a secret formula. You put certain things on part of the ledger and certain things, but that's okay. I appreciate it. Thanks.
Yep.
Dustin, do you mind if I provide a couple of comments on that as well?
Yeah, go ahead.
And I love the question. When I do quality of earnings, there's really three types of EBITDA, and I'll go from top to bottom. There's EBITDA as defined, and there's no argument there. It's earnings before interest, taxes, depreciation, amortization. It's just exactly as it says. There's no argument. It's all there in the financials. Next line down, then you have management adjusted EBITDA. And that's where the sellers or the target can say, hey, we present these as we know as one-time or non-recurring items, as well as non-operating items. And that's what and usually the iBankers, will help to propose that. And then below that, you have what's called diligence adjusted EBITDA. And that's where someone like me, a QV guy or a buyer, will hire a QV, firm to come in and say, okay, we're going to actually diligence all these adjustments. And whether we accept, reject, or do different ones, that's the true from their perspective or my perspective, what the actual adjusted EBITDA is. So there's kind of your three. EBITDA is defined, management adjusted EBITDA, and diligence adjusted EBITDA. Now, keep in mind, quality of earnings, there's that quality in there. And this is what Dustin's explaining. The more that there's a gap between true EBITDA as reported and actual adjusted EBITDA, if that gap is in that example is 33%, then that quality drops and therefore the valuation drops. Thanks, Dustin.
Thanks, Patrick. Yeah, he put
Yeah,
it
thanks for that,
he,
Patrick.
he
Appreciate
put it a
it.
lot better than I did. Thank you.
All right.
I've done this once or twice, but
Yeah,
I don't do valuations, but I do I do QAVs quite often.
yeah. So these are some fresher examples. I want to get through these pretty quickly here, but here's an IT asset disposition business that had some concentration risk. This company was doing about 25 million in revenue, 12 million in EBITDA. However, they had one key customer that was represented roughly 50% of their EBITDA. Really great customer, very high margin. Um, Prior to knowing about this customer, the the firm that wanted to buy this company started out at a 9.4 times LTM EBITDA multiple. And then once it came to light that there was this really key customer and that things were actually not going well, there were some issues with this customer, the valuation was renegotiated to a 6 times EBITDA. So 3.4 turns, uh, that that hurts at the end of the day. Uh,
That's good.
yeah, go ahead. Oh,
Mark, did you have a question?
Oh, no, huh? No,
okay.
been through a similar experience. So that's all. Commenting to myself.
Yeah.
Well, actually, if you don't mind, can you share that experience with us?
Oh yeah, sure.
Yeah.
So the first background is that, or backgrounder is that, we're more an acquisition of privately held firms, right? Uh, uh, so anyhow, with that in mind, we were looking at acquiring a marketing firm, it's big in educational market across basically grade school, high school training sessions. And the long story short, it was a little bit like pulling teeth at times from the particular owner. When we finally did, I mean, it came down to a simple ask for QuickBook access, right? So we kind of studied cash flow and a couple other things. Um, it was a heavy on client concentration. So there was one client that had kind of the corporate branding name and then different divisions underneath that they worked with, but it basically all rolled up. I shouldn't say all, about 65% of his revenue was tied to this one piece. But we had spent a few months in all the other discussions and he's really reluctant to share some of the financial data until we were at the point like, if you don't, then we're walking away. And once we did, we discovered that these other divisions rolled up to the parent company basically, and that was about 65% of the revenue. So we know why we knew why he was being a little shy to share the information. And we talked with him and his broker and said that's it's not kosher. Even the broker didn't know this himself, right? So they didn't do a lot of the
Yeah.
homework up front, and we didn't lose anything other than time and money and frustration. But, so I kind of chuckled when he went through this because it sparked the
Yeah.
memory a couple years ago.
Well, and I think it's really important for us as business owners out there that are wanting to grow significant impacts, both from a financial standpoint to understand the end in mind and just build with an understanding that customer concentration is one of the most, it's one of the risk factors of value within the business. And
Hmm.
that's in essence why I love these conversations with Dustin, Patrick, and people like yourself that have been in the seats of making an acquisition, just to help to teach the younger generation and those that are currently building to continue to make sure that you build wise. And anyway,
Yeah,
I guess we
yeah,
this
exactly. So
this is the yeah.
it's a good learning experience for us. And ultimately the guy was kind of shady because he broke them out separately and all the other data as individual clients. So the client concentration looked normal at first.
Hmm, that's good. Awesome. Right back to you, Dustin. This is your
Yeah,
show.
yeah, no, I love the additional commentary and the additional examples. This is great. Uh, you know, Sometimes we do our business owners do their best to build a bulletproof business, and regardless of all that effort, they could have great customer diversification, they could have supplier diversification, they could have great management, a deep management bench of people coming up through the company to take over existing key leaders, great systems. Despite all that, things can change in an instant with regulations. In this next example, it's a gambling IP licensing business where that was just absolutely crushing it. And uh, however, then July 4th came around, and the one big beautiful bill was passed, and somebody snuck a um, some legislation in there that made it so gambling companies could not deduct 100% of their gambling losses anymore, and they changed it to 90%. At a high level, that doesn't sound like a big deal, but this company in particular was a very high volume betting, very, very low margin. So to make that kind of money, the 50 million, they were betting $1 billion a year to get that and making very, very small profits. You take away the ability to deduct all the losses that they had, all of a sudden their business is now upside down, just with the pass of some new legislation. So lobbyists are trying to change this situation as we speak. Um, but you know, this just proves that we can do our very best sometimes, and even our very best can be undone with the signature. And then in this next example, this is more focusing on the supplier side of things. Uh, very good furniture wholesaler, 20% EBITDA margin business, billion in on its way to $1 billion in revenue, does not own any of its manufacturing base. So purely this business designs and wholesales company and relies wholly on third party manufacturers to produce all of its stuff. And most of that manufacturing was done in China. So again, that's a pretty big weak spot where, especially right now with all the tariff uncertainty, having most of your stuff being produced in China. So the company is very actively working to mitigate that exposure to China by diversifying its manufacturing base throughout other locations in the world. So I guess I'll end with saying, look at your business, try to look at it with the eyes of a buyer, and ask yourselves, what is not attractive about this? And once you identify those items, actively work to try to de-risk, mitigate that risk. And going back to some of these examples where we're taking haircuts of three turns of EBITDA, you don't want that to be you. So now's the time to be actively looking at your business and trying to mitigate risk however you can. And I think I'll stop there. We're Nathan.
Yeah.
It
Yeah, that's
feels like
good.
we're at time. Um,
What I can do is I can send out the slide, or if this is okay with you, Dustin, just to have the slide deck or be able to share it or in some way, shape, or form.
That would be
Um,
great. Thank you.
Yeah,
yeah,
just lots of value. Obviously, Dustin has again, he's been supportive of the acquisition conference as well as just providing his time and information right now for AHQ. And, again, you can learn more about Dustin with AltaView Advisors and just what they're doing over there. But really at the end of the day, it's our effort at acquisition headquarters to make sure that you have the value necessary both for the creation of value within your company, but also strategic acquisitions, as well as fundraising and then distribution of capital and various alt investments as well. So as we continue to build out our educational platform, we're excited to have people just like Patrick, who's one of our founding members. And again, thank you so much for joining us today. And then Dustin, for your information. Mark, did you have any lasting questions or comments?
No, I mean, well, I guess I have a comment. Yeah, thanks for doing it.
Yes, sir.
I'm not the finance guy of the partnership, so I'm here to try and catch up with my partner. So I can understand what he's talking about more so and take some of the burden off his to-do list as we continue on. And thanks, Patrick, also for your deep dive there on the, I don't know what you call it, the management and diligent adjusted. So appreciate that.
Mhm. Yeah, absolutely. Um, and I wanted to share a little bit more about what it is we're doing with the acquisition headquarters. Can you guys also see what we're sharing at the moment?
Yeah. Mhm.
Okay, yeah. So the Acquisition HQ Network, just a high-level overview of what it is we've built and also what we will be building in the future. Number one, again, it's very strategic to be able to connect with individuals that can help to collapse time, increase your access, and continue to create value for you in your business as well as within your life. And we believe that we've created a very solid community of people that are doing that. And when we do that in a few ways, we have an access to a web app community. We've curated introductions to strategic partnerships through our community management. We also have a free entry into the AIQ Council and meetings, and each of those councils will be launched in 2026. We have scheduled launches in Austin, Nashville, San Diego, and Salt Lake City for our monthly meetings, so we're excited about that launch. As a part of a membership, you have access to the tech stack, and that is our web app, like I was saying. And it's just continuing to build out as we have various members across the nation that are joining. And that, in order to access all of this, you do receive a bunch of value as we've already talked about. We've got the online educational workshops. Yes, you have access to that as a non-member and also access to our YouTube content as a non-member. But everything else, you have to be a member in order to be a part. But we believe again that it's of significant value to be able to do so. And all of the things that you see on this right side it's for 3K per year per person. And that enables you to have, again, free access to all of our councils, access to our deal flow, access to a free ticket, actually, that's a VIP ticket to our upcoming conference, and the ability to also share your knowledge and be able to connect with others that are doing so within the network. Again, our national conference coming up on March 5th and 6th in Salt Lake City. It's a 2-day event. We're excited about the evolution of the brand and also those who are associated. Also, we have our Alaska retreat. I'll leave it here for you guys. This is a part of our AHQ initiative to make sure that we have a well-balanced understanding of the value of both experiences that will allow us to be our best selves moving into year 2026. It's going to be up in Fairbanks, Alaska. And currently, we're excited to be able to release the top of the world mastermind experience. And if you guys have any further questions, one, you can apply for membership at the acquisitionhq.co/network. Learn more about the acquisition headquarters, where we're at, where we've been. And again, we're so excited for the growth into 2026, and we want the same for you. So any further questions or comments, feel free to get us at nathan@growthbounce.co. And we're here to help. So thank you so much for joining us again today. And I'm actually going to stop with our recording and be able to connect with you guys offline here.
Yeah. Sounds good. Yeah, I appreciate it. Thanks for all the info. I can tell right now I'm going to pass on your December 30th offer. It's a little chilly for me.